Hey everyone, it's Brett with Investing on the Go. I help everyday people take control of their money through simple, actionable personal finance videos. No fluff, no complexity, just what actually works. Today we're covering the 5 signs that it's time to hedge your portfolio with puts. Each week I share strategies that help you budget smarter, save more, and invest with confidence. So, if you're ready to master your money, hit that subscribe and give this video a big ol' thumbs up. Let's go ahead and grow together. Now, really quick, before we jump into the market signals, I launched a free Discord community where we can all talk about personal finance together. It's a judgment-free space to ask questions, share wins, and share personal finance experiences together with other people on the same journey. So, whether you're just started or already investing, you're welcome to join us using the link down in the pinned comment down below and also in the description. All right, let's go ahead and get with the signs. Why hedging matters. Everyone and their brother tells you to just buy the dip, just buy the dip. But what if I told you that for the past 50 years, some of the biggest fortunes were protected or even made by investors who knew exactly when to stop buying the dip? What if blindly dollar cost averaging into a falling market is one of the sneakiest ways to wreck your portfolio? In this video, we're going to go ahead and discuss the 5 critical market signals the professionals use to know when it's time to stop accumulating, dollar cost averaging and start protecting your portfolio. We're going to go ahead and cover some of the flashing red lights and tell you when it's time to be hedging with puts. This isn't about being a pessimist, it's about being a realist. It's about taking control, managing your risk, and making sure that one bad year isn't going to wipe out 5 years of your hard work. So, what exactly is hedging? So before we jump right into what is hedging, think of it like buying insurance for your investments and your portfolio. You do end up paying a small known cost, the premium, to protect your portfolio from catastrophic losses, but essentially it does create a floor. With hedging, you use tools such as options. This is the tool of choice, which limits your losses during crashes while keeping your portfolio ready for the rebound. It's a strategic move, not a fearful reaction. Now, let's go ahead and get into the signals. Sign number 1, market volatility is spiking. So, all right, sign number 1 is the classic, a sharp spike in market volatility. Your best friend here is the VIX, also known as the volatility index. The media loves to call the VIX the fear gauge. And for good reason. In simple terms, the VIX measures the market's expectations of volatility for the next 30 days. But when the VIX stay low, say below 20, investors are feeling pretty calm. But when it does start climbing, especially when it crosses over 25, 30, it's a sign that fear and uncertainty are taking over. So why should you care? A rising VIX means that the market is bracing for bigger price swings. Historically, when the S&P 500 falls, the VIX spikes. During the 2008 financial crisis, the VIX shot up well over 80. Here I took a snapshot of it. I couldn't quite get the top, but here we're showing a VIX of 70.33, where the top was up in the 80s. In March of 2020, the VIX hit a high of around 82.69. Once again, I couldn't get all the way up there. I got a snapshot up there of 65.54. And then recently here in 2025, during the February-April tariff, debacle, the VIX spiked up to 45.31. These are not just numbers, they represent moments of extreme panic when unhedged portfolios got absolutely crushed. So here S&P 500 in the red is moving on its way down, right? That volatility is kicking in. Here we have that VIX beginning to spike. I went ahead and included here the current numbers of the VIX is 18.44. This was at market close on Wednesday. I know that here on Thursday, markets open were negative more than 1%. So I'm sure that the VIX is a little bit higher out there because I knew some new data came out there causing this kind of spiking around. But by watching the VIX as your early warning system, it tells you the risk of sharp decline is growing. Now, buying insurance during a hurricane is expensive, right? Same idea goes here. Buying put options when volatility is already at high cost more. But it's also when the protection is most valuable. If you see the VIX ticking up every single day, day after day, that's a clear signal to start thinking about your insurance policy. Sign number 2, you have a concentrated position. Sign number 2 might hit a little closer to home. It's not about the whole market, it's about your portfolio. Do you have a huge chunk of your wealth tied up in a single individual stock? By huge, I mean more than 10 to 15% of your total portfolio value. This happens all the time, especially if you work in tech and get paid in company stock. Maybe you're a longtime employee of a major company, and over the years, your stock grants have ballooned into a life-changing amount of money. While that's an amazing problem to have, you're also hitting a risk-themed time bomb. Company specific risk. No matter how invincible a company may seem, it's not. A bad earnings report, a new competitor, a regulatory headache can send stocks into a nosedive, even if the rest of the market is fine. If most of your net worth is tied into one company, your entire financial future is riding on its fate. Here, I went ahead and included a snapshot of Netflix just recently. As of October 21, it is down well over near 12%, plus including today. I believe it's down another 2 or 3%. Here, Meta was doing really well in my portfolio. And then just within the last, since October 29th, right, not even 2 weeks, it is down over 17% and is down even further. And then here, this is a snapshot of, I believe this was NVIDIA potentially. I'm not sure which one this was. I guess I snapped off the actual ticker there. This was Palantir. So Palantir is down around 13% off highs. So yeah, these new competitors, right, it can come down due to earnings, new competition, overspending on AI. Now, let's walk through how a protective put works. This is where hedging with puts is a lifesaver. By buying put options on a specific stock or ETF, you can protect yourself from a sudden drop. For example, if you own 800 shares of, for example, I went SPY here, and the stock price as of Wednesday close was $677.58. That would say that you have $550,000 roughly on the line. Now, you could buy 8 put options, right? You have 800 shares. You can buy 8 put options at a 664 strike price. That is just using the 50-day simple moving average. I went ahead and included here a snapshot here on the right-hand side. And here on Fidelity, I went ahead and drew this up just so you can kind of see how this all would play out. If you're right and the stock tanks to say $664 or beyond, your put option will explode in value, offsetting the big chunk of losses on your shares. You've essentially built in a safety net. This strategy is called a protective put, which gives you peace of mind to hold your winners without being exposed to a catastrophic loss. Now down here, I went ahead and included a few different examples. So example 1, even though you're not in the money, right? We bought a put option at 664. The put option was still increased in price due to the market expectations that it could go into the money if the drop continues. So by the put option itself, put would potentially rise here. So when you bought this put option at 661, because of the volatility, because of the sudden drop, that put option became more expensive. It now is at $8.50, potentially $9. Now, if you went ahead and sold that put option, right, you bought that contract, now you could sell it for a potential gain of that difference of $1.89 times the amount of shares that each contract is worth, times the amount of contracts that you purchased, you have downside protection of roughly 1,512. Now, if SPY continue to fall even beyond your strike price of 664, for example, here we have the current 200-day moving average down here at $610. So for example, if the S&P 500 just fell through the 50-day moving average, fell all the way down to about $640, that would be a $24 below your put option strike price, plus that time value. Your contract will be worth roughly $26. Again, times that by 100 shares per option, multiplied by 8 options, that would net you $20,800. So while it did cost you roughly $5,288, right? Because you got these fees plus the order value itself, your net value would return you roughly $20,000 if this happened, right? If it fell, not only touching, right, it kind of gives you, Fidelity is really good on this. So your break even point for the amount of money that you spend on this put option, the stock price would have to fall to $657.39. Let's go ahead and put us image here on the screen of today's market volatility, where we are currently at in the market. Looking at the market right now, I'm sure it's fallen quite a bit. So this put option is going to be more expensive. So I'll go ahead and put the same option right now that we had market volatility on Thursday, you guys can see the difference of how much that put option now costs for that downside protection, right? It would be already, if I had bought it on Wednesday, that put option would be protecting me in some way already, offsetting the losses that took play on today's market downfall, right? So this is just a really good, easy example of how a put option would work to protect your portfolio. Sign number 3, market sentiment is turning bearish. Sign number 3 is all about reading the room, the giant chaotic room that is the stock market. This is less about one number and more about seeing a collection of clues and data that shows the market mood is souring. So one of the best tools that I like to look at is called the CNN Fear and Greed Index. I like to include this in all of my SoFi investing videos. It was at 33 the other week, 37, and now as of Wednesday, when I was recording this video, it's at a 24. Extreme fear. It blends 7 different factors into a score from 0 to 100. When you see the index stuck in the fear or extreme fear, even as the market churns near its highs, that's a huge disconnect that smart money is paying attention to. Another one here is the great gauge of the AII Investor Sentiment Survey, which has been tracking individual investors' feel for the past decades. It's often used as a contrarian indicator here. When the overwhelming number of investors are bullish, it means that the top is near because everyone who could be buying already has. Conversely, when the bearish sentiment spikes, it's a signaling a bottom. According to October 2025 survey, bullish sentiment has risen sharply, which has also been a paradoxing signal growing complacency for the fall. So watch for complacency near highs. Right? Everyone's kind of buying into the market. People are using leverage. People are using margin, right? You see a lot of these videos out there of investors using margin. And then finally, look at the chart. Is the S&P 500 breaking below key support levels like its 50-day moving average, its 200-day moving average? A break below the 200-day is a classical technical sign of long-term uptrend is in trouble. So when you do see these signals line up, it's a sign that the buy the dip crowd is in for a nasty surprise. That's your cue to potentially hedge with some put options. Now, we are halfway through our video, guys, so go ahead and do a quick check-in in the comment section down below. Have you guys ever considered using put options to hedge your portfolio? If you have, let me know down in the comment section below. Or is this a completely brand new concept for you? I do read and respond to every single comment here, so go ahead and drop a comment down below. Let's go ahead and start a conversation. Now, sign number 4, major capital is a need in the horizon. Okay, sign number 4 is the most personal one on the list, and honestly, it might be the most important. Are you nearing a big life event that requires a lot of cash in the next 1 or 2 years? I'm talking about a brand new home, retirement, a kid's college tuition, your college tuition. If the answer is yes, then the stakes of the market crashing just got exponentially higher for you. When you have, say, a 20-year horizon, you can ride out a bearish market. You don't need the capital right now. You're already getting paid. You're just investing into the red. But if you need that money in the next 18 months as the down payment, a 30% drop isn't a paper loss. It's a direct hit to your lifetime plans, because if you need to withdraw that at any time when it's into the negative, you're withdrawing at worse times. Like, you should be pumping money in versus taking money out. So this is where the just buy the dip mantra completely fails. You don't have time on your side anymore. Your primary goals have shifted from maximization to wealth preservation. And then hedging with long-term put options, known as leaps, can be a brilliant financial planning tool here. They can provide protection for a year or more. While they do have a cost, the cost buys you certainty. It ensures that if the market tanks right before you need your money, your capital is protected. Think of it as locking in your gains. You worked hard to get here. Using a small piece of your profits to buy that protection is a small price to pay to guarantee a crash doesn't derail your life. So short options, right? Short put options, they kind of keep you in that protection from those 5, 10, 15% drops. But long term, if you're thinking it's another 2022 and you could run those leap term put options where you put a put option a year out, half a year out, when the market tanks 22%, 30% throughout a year, that's going to build you in some downside protection in the event you have these big upcoming events, right? And then sign number 5, your buy the dip strategy is becoming dangerous. The final sign is a tough pill to swallow. It's the realization of your go-to strategy to dollar cost averaging might be leading you off a cliff. This works more often in individual stocks than into ETFs, right? That track index, but we all love dollar cost averaging, right? It's the sensible, disciplined way to invest most of the time. But here's the dangerous misconception. Dollar cost averaging doesn't work perfectly in every market and with every stock. The danger comes when you keep buying into severe long-term bear markets. Buying the dip at 5% down seems smart. Buying again at 10% down seems like a bargain, but what about at 20, 30, 50%? At some point, you're not just lowering your average cost, you're just throwing good money after bad. There's a lot of stocks out there that regardless of how often you dollar cost average them, they just never recovered. This is when you have to evolve. It's when you have to see other signs we've discussed: spiking volatility, souring sentiment. These signals are out there, and this dip is different. It's not a healthy pullback, it's a start of something worse. Now, consider pivoting your aggressive buying and reallocating that cash towards protection. Instead of buying more shares, use that money to buy put options to hedge your portfolio you already have. This shifts your position from purely offensive to defensive. You're going to go ahead and preserve your capital so that when the market truly bottoms out, you have the firepower to step back in and buy at generational lows. That's how smart money not only survives, but comes out far wealthier. Smart money not only survives a crash, but comes out far wealthier. I don't know why I cut off wealthier here, but it does, right? So here's some referral options, guys. If you guys are looking for the right tools to manage your investments and finances, here's 3 tools that I personally use to keep everything organized. SoFi Money, you guys can get up to $325 bonus, a high APY on savings, such as 3.8% last time I checked. Plus, you get checking, credit card, and investing in all in one place. Speaking of investing, you can get started with just $25. Then you'll get a $25 for free, and you can join our $1,000 investment challenge. I do have links down in the pinned comment down below to get a free $1,000 investment tracker, also a free $0 budget tracker. Now, I do have other links down there if you guys are interested in checking out Robinhood or Public or other platforms. So just kind of take a look down below. Also, Policy Genius, get fast, affordable life, home, auto insurance, tailored to protect your family without breaking the bank, right? Policy Genius, I picked up a policy on my life insurance at 1/3 of the cost for the exact same policy by using Policy Genius versus Ethos. So definitely check them out. So that's essentially it. If this video gave you a practical way to think about protecting your finances, please do me a favor, go down below and hit that subscribe and thumbs up. It really helps more people discover these simple money strategies and tells YouTube to show more of my videos to investors. So your guys' next step, go down below, grab the free $0 budget template in the description down below. It's the exact system I use to track where every single dollar goes, and it takes less time than making a coffee. Also, remember, you guys can join our free Discord community, share which hedging signs you're looking for. You can ask questions, connect with others on the same journey. I'm in Discord every single day. And drop a comment down below and let me know which of these 5 signs was the biggest eye-opener for you. I'd love to hear your guys' thoughts. Thanks again for watching. I'll see you guys in the next time. If you have any specific questions, drop them in the comment section down below or join the Discord and ask me there. Thank you all. See you guys in the next one. Bye-bye.